Welcome to On Investors' Minds. I'm Tai Hui, the Chief Market Strategist for Asia Pacific at JP Morgan Asset Management. And thank you for giving us a few minutes of your time to understand what investors are thinking about right now and how that fits in with building the right portfolio. So we just released our long-term capital market assumptions. This is an annual publication focusing on the long-term 10 to 15 years of return projection for a broad range of assets, including equities, fixed income, and alternative assets. Now, the 2026 edition is also our 30th edition of LTCMA. Now, this document has guided nearly $1 trillion in assets around the world and consistently delivered results within half a standard deviation of the actual 10-year returns 3/4 of the time, underscoring their reliability and the value in portfolio construction. Now, the 2026 outlook is shaped by three powerful forces. Number one, economic nationalism. We're expecting more protectionism, less immigration, and that will lead to slower growth and potentially nudging up inflation. Number two, fiscal activism. Governments, especially in Europe and China, are spending more to counter headwinds. Number three, technological tailwinds. Artificial intelligence and robotics are set to boost productivity for years to come. Now, it is important to remember that the economy and the stock market don't always move together. The global economy is like a tortoise, steady and slow, while markets can be more like a rabbit, racing ahead. Despite strong recent returns, long-term U.S. equity growth projections remain steady. Fixed income is looking better than before thanks to higher rates, and the dollar's long-term decline supports global returns. A traditional 60-40 portfolio of stocks and bonds is still solid, but adding even a small allocation to alternative assets such as real estate or private credits can boost returns or lower risks. When looking at the macro projections, we've seen the U.S. long-term growth estimates reduced. Europe's growth is up thanks to fiscal spending, and China's inflation forecasts are revised down due to excess capacity and tariffs. When it comes to portfolio construction, market dynamics and resilient portfolio construction are the key themes for the coming years. First of all, it's about growth and productivity. While headline economic growth is leveling off, productivity and investment are increasingly driving returns, supporting capital share of the economy and offering a positive outlook for investors. In equities, U.S. equities remain robust in the long term due to the strength of the corporate sector, particularly in capturing revenue and profitability. Despite valuation headwinds, revenue growth is expected to sustain strong returns in the long run. International equities, including developed and emerging markets, offer complementary opportunities, with the currency effect or a long-term weakness in the US dollar playing a significant role. For fixed income, the normalization of yields after the pandemic has removed previous drags on return. Higher starting yields and a steeper yield curve now provide attractive returns across the fixed income spectrum for the next 10 to 15 years. Bonds are expected to serve as an effective hedge during future growth slowdowns. Currencies. The expected decline in the US dollar in the long run is now more likely to be driven primarily by Asian currencies, for example, the Japanese yen, the Korean won, and the Chinese yuan, rather than European currencies. This shift provides a substantial tailwind for emerging markets and also Japanese assets. Alternatives. AI and technology are increasingly dominant in private financial alternatives, with a significant proportion of private credit, private equities, and also venture capital linked to AI innovation. Infrastructure and real assets, such as data centers, also benefit from this trend. Now, how do we implement these recommendations into actual portfolio constructions? Diversifying beyond traditional public stocks and bonds offers significant benefits, but at the same time requires careful consideration. Even a modest 10% allocation to alternatives can improve returns and reduce volatilities. The right mix depends on your goal, risk tolerance, and liquidity needs. Alternatives can be grouped into three categories: diversifiers like real estate, infrastructure, timber, gold, and hedge funds. Income-focused assets such as direct lending and private credits, and alpha-focused assets like private equities and venture capitals. Now, of course, some of these assets can offer more than one attributes. For example, infrastructure and real estates can be diversified alongside with being income-focused assets. So from that perspective, it's important to choose the right alternative assets for your portfolio. It is important to diversify not just across asset classes, but also within them. The old negative correlation between stocks and bonds isn't as strong as it used to be. Alternatives are essential for managing risks, especially during inflation shocks. Now, for many investors in Asia Pacific, increasing allocations to international developed and emerging markets beyond the US and your home market is also key, both for return enhancement and also for diversification. Now, implementing alternatives require careful attention to fund structure, fees, and manager selection, given the wide range of outcome from different managers. While private markets have raised a lot of capital recently, deploying it has been slow due to market turbulence. In private credit, increased competition amongst lenders has compressed yields, while normalization in capital markets should facilitate more activity in private equity and venture capital, especially in AI-related sectors. Now, increasing allocations to international, developed, and emerging markets is also key for APAC investors who may be more focused on the US as well as their home market, both for return enhancement and also diversification. The US has underperformed international markets recently, and also the currency movements have further underscored diversification benefits. Now, thanks for listening. If you enjoyed this podcast, please share this with your friends and colleagues and consider subscribing. If you have any topics you would like us to cover in the future, please reach out to your JP Morgan Asset Management client advisors. To access our long-term capital market assumption papers, please visit our website or our Market Insights app. I'm Tai Hui. I'll see you next time to discuss what's on investors' minds. Meanwhile, stay informed and stay invested.
This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan, feature, or other purpose in any jurisdiction, nor is it a commitment from JP Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only based on certain assumptions and current market conditions, and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks. The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. JP Morgan Asset Management is the brand for the asset management business of JP Morgan Chase & Company and its affiliates worldwide.